So welcome to everybody. This is a webinar about COVID-19 in developing economies, CEPR, Vox EU ebook done in cooperation with the International Development Policy, which is a journal published at the Graduate Institute in Geneva. And I edited the book together with Simeon Jankov. The book touches on a series of topics. It's many chapters, and today we're very lucky to have three of the authors of the ebook that will talk a little bit about their chapters. But I guess they're experts and can talk about pretty much everything. So I'm sure we can ask them questions about a variety of topics. So we have Swati Dhingra. Swati is a professor at the London School of Economics. She works on globalization, industrial policy. She wrote a chapter in the ebook focusing on informality. She has written, she has contributed to a recent report on life after Brexit, which is, I haven't read it yet, but now I'm looking forward to it. And she has won several awards, so it's great to have Swati here. Our second speaker is Caroline Freund, who is the Global Director of Trade, Investment and Competitiveness at the World Bank. Before that, she was at Peterson Institute. Before that, she was at the World Bank. She was the Chief Economist for the Middle East and North Africa region. By the way, we also have a chapter in the ebook that focuses on that region, so we might ask Caroline. She didn't author that chapter, but I'm sure she knows about it. She wrote a super cool book about rich people in poor countries and several publications. And last but not least, we have Andres Velasco, who is the Dean of the School of Public Policy at the London School of Economics. Andres has a career both in policy and in academia. He has been a professor at Columbia University, at NYU, at Harvard. He has been Minister of Finance in Chile. He has been a presidential candidate in Chile, and has written tons of papers. And he also contributed to the ebook on an article talking about the macroeconomics of COVID, joined with Luis Felipe Céspedes, which I think he was your student at some point at NYU.
Was indeed.
And Roberto Chang. So let me start. Maybe what we can do, I can start by asking one question each to our three speakers, and then we open for questions. So you can please feel free to use the Q&A button to ask questions. And if you would like to leave instead of live, instead of typing, just raise your hand and we'll give you the mic. But let's start with three, with one question each, which I'll ask. So let me start with Swati. So many advanced economies responded to the COVID crisis by expanding their social safety net, and but this has been more difficult in many developing economies, and there is a series of reasons for this, which it would be great if you could talk a little bit about it, maybe with a specific focus on the role of informality. And then in your chapter, you discuss some ideas that could be adopted maybe when the pandemic ends, to facilitate the transition and in general to provide a safety net in low-income countries. So Swati, if you can talk a little bit about that.
Sure. I'll just start with highlighting very broadly what the situation is and then get on to the very specifics. So broadly speaking, informal employment makes up the bulk of employment in developing countries, in particular countries like India, where this number could be, estimates suggest anywhere between 75 to 90%, depending on how you define informality. Most of these people don't have regular wages, they don't have regular days that they go to work, and therefore they're just much more precarious than people who have regular salary jobs, sort of traditional jobs that we think about that give you some level of tenure protection. And one of the things that happened almost immediately after the crisis was a very, very big dip in urban unemployment in India. Sorry, big increase in urban unemployment in India. And one of the reasons was that the bulk of the workforce is in informal work, and therefore they can easily be fired or hired at will, which in some cases has its advantages of making the economy more flexible, but it also imposes these costs that workers are really sort of in much more precarious work. So a lot of what happened in India right away was people sort of trying to get food, basic temporary relief to be able to face the pandemic. That happened fairly quickly in India because the lockdown happened quite suddenly. So the need for food rationing and the need for those rations arose very quickly. And there were a whole bunch of people who weren't able to get back to their residences, which is how most welfare payments in India are tied to. They're tied to the region they belong to, not really to you as an individual. So in that sense, a lot of people who were away from home, migrant workers, for example, were really sort of had absolutely no access to any of those welfare payments. One of the things that the government did try to do immediately was to come up with cash transfers so that that could be channeled into bank accounts of people who are really suffering. The problem with that has been, in the case of India, even though it started its cash sort of biometric bank linking 11 years ago, till today, people still get left out from that sort of directed cash transfer system. One of the reasons being the same issues that create exclusions and omissions in usual sort of data collection end up coming up even here when we think of sort of bank associated transfers. And that's the reason a lot of people have gone beyond just sort of very specific recommendations about transferring cash to saying something more about that we need to have a public distribution system of food rationing that's much more universal. And one of the other ideas which is there in India is about having an urban job guarantee that can try to provide work to informal workers to avoid long-term unemployment. The reason that's arisen is because it has the advantage that it's a universal policy in the sense everybody is entitled to work under the India already has a program in rural areas. So if you're a rural landlord or if you're a rural farmer, you can go to the government and say, I've had no work this year, and therefore please ensure that I get 100 days of work, and the government would provide you work. It's the biggest welfare program possibly in the world, and definitely one of the biggest jobs programs that's ever existed. The problem with that is it's restricted to rural areas and doesn't stretch over to urban areas. So you could be an urban poor person and you wouldn't be able to access this program. And one of the ideas out there is to make the program much more universal, to extend it to urban areas so that everybody comes under the net and has some kind of lifeline. And that's what we're seeing happen in rural areas already, that a lot of people who've lost work over the past couple of months during the lockdown are now turning to these rural employment programs to be able to avail of that. But that sort of program doesn't exist in urban areas, and now there's some talk happening within government to try and extend it or to think of possibilities where state governments might be able to do that. So just to give you a sense of the scale of the problem, we recently did a survey of 5,000 individuals in the three sort of fairly poor states of India, Uttar Pradesh, Bihar, and Jharkhand. And I'm going to show you one slide. These are workers who, on median, have lost 50% of their income in the last 2 months compared to when they started out in the beginning of the year. So 50% median drop in income for individuals who already are sort of at fairly subsistence wages, many of them. And this is what we asked them. We asked them how much they were willing to be able to pay. So it was an experiment designed in a survey to try and ascertain whether people do want a job guarantee, how much do they value it. So on the y-axis, what you can see is the percentage of people who would rather choose a job guarantee than a job that provides them possibly a higher pay. And that's how much they're willing to forego of wages. So if you look at the line which says the x-axis from 0 to 40, this is how much people are willing to give up to be able to get a job guarantee associated with them in their jobs. So, you know, at the really top end of the income of the distribution, if you see 70, that's basically people who are unemployed at the moment and who have absolutely no job guarantee associated with their jobs. And they would be willing to, you know, if you don't ask them to pay up for a job guarantee, most of them are going to want to have a job guarantee in their jobs. But as you keep asking them, how much more do you value it compared to what you currently have? Then of course the numbers start going down because now you're actually making a payment to be able to earn a job guarantee. And this gives us some idea of being able to evaluate how much do people actually value these non-pecuniary benefits in jobs, which typically aren't available to informal workers. And we want to be able to get some idea of how do you monetize that cost. Broadly, what seems to be the case is that if India were to come up with a job guarantee scheme that extended to urban areas so that people don't end up in long-term unemployment, then the costs aren't extremely high. So even extending it at a fairly reasonable number to urban workers would amount to something which is under 3%, even in a very generous wage, you would end up with just under a pledge of 3% of GDP, which isn't a really big sum if you're trying to avoid people getting into the really scarring effects of long-term unemployment, sort of discouraged workers. So I'll stop there with the idea that, yes, broadly, informal workers seem to have done really badly in this crisis. And one of the schemes out there that can potentially help with this and which has been used previously and has worked well is some kind of idea of a job guarantee so that so that the information and infrastructure which is typically needed for schemes like UBI, we don't necessarily have to have those, which, in developing countries often won't exist.
Thank you, Swati. We're getting already questions about India, but we'll get to that later. So let me move next to Caroline. So Caroline, as I mentioned before, Caroline is the director of trade, investment, and competitiveness at the World Bank. Every once in a while, regularly I get emails from her office telling us what's going on in trade. So that's tracking trade is part of her job. So I wanted to ask Caroline two questions. The first one, if she can tell us a little bit how the pandemic is affecting global trade and what has happened and what are her expectation, what's gonna happen in the near future. And the second question, which is more related to the chapter that she co-authored for our ebook with some members of her team, which is, if we can put some positive spin, some silver lining of the pandemic, of the crisis, because maybe this could lead to the reallocation of some global value chains for countries which are able to use this opportunity. And she, with her co-author, used an interesting experiment to study this. So can you tell us a little bit about these two issues, Caroline?
Sorry, I wanted to unmute because I have a dog and I was worried he was going to bark earlier. So, at the very beginning of this, the shocks emanated from China, and there was a lot of concern about supply chain disruptions. And companies were quickly looking to map their supply chains and figure out how dependent on China they were. But then as the virus spread around the world, it really became much more of a global demand shock and to some extent supply shock. But the demand really looms larger. And we've been monitoring trade closely. And what you see is in March, it was down, this is values, 10% relative to March the previous year. In April, it's down about 20%. And it's much, much worse in developing regions now outside of East Asia, where they've managed the lockdowns and the virus itself much better. So you see declines from 30 to 50% in developing regions. So really, really sharp drops in trade. There's a little bit of good news on the horizon. We're also monitoring containers, the container capacity on ships, and that can be monitored in real time. And we see an uptick at the end of May and beginning of June. So it looks like April may have been the bottoming out period. But what's interesting too, when you split the trade across capital goods, intermediates, and consumer goods, is consumer goods and capital goods were really the ones that dropped first. And then only after that, so that happened in March. In April, did you really see intermediate goods having big declines? And so it seems that also indicates this side of the demand shock. And then the one area where trade has actually grown is in intermediate food and beverages. So trade is actually up from the same period last year. And in part, I mean, people obviously still need to eat, but it's a very good sign because there was some concern about food security. There's ample supply right now of the main intermediate food items, wheat and enough rice, and it is still being traded, and quantities are actually, or values are actually up. So that's a little bit of good news on the trade outlook. In terms of what we look at, and in the reshaping of supply chains is, in a systemic crisis like the current one that's really hitting all countries, it's very different from an idiosyncratic crisis where you may think about moving away from a specific country. So if you had all your intermediates from home and your supply chain at home, it wouldn't necessarily help you because there's lockdowns in the home country as well. But at the same time, what firms are starting to realize is they may be too reliant on specific countries. And if there's a shock in that country, there's a problem. And China's really the one that comes to mind, both because of what was happening before the pandemic with US-China trade conflict and tariffs, as well as at the beginning of the crisis when when firms realized they were highly dependent. And so what we do is we look at what happened in the Japan tsunami, which had big effects, especially in the auto sector, where over the short run, over the next 3 months, inputs fell about 50% from Japan, imported inputs in specific product lines on average. So what we do is we look, what did producers do after that? It was only a few months that they were really shocked, but there's just-in-time inventories now. As you know, in some car companies, they're down to the hours in terms of how long they're holding inventories for before bringing them into production. So what we look at is what happened over the next few years after this shock. And we separate goods into those where countries, importers are more dependent on Japan, so 15% or more of their total inputs of that product, so it could be a steering wheel or a muffler, some very specific product comes from Japan, versus those where they take a lower share. And what you see is in these high share products, there was a really steep drop in terms of imports of those products that was persistent after that shock. So they fell by 10 percentage points. And so what happened? One possibility is they realize they're too reliant, and so they diversify. They look for more suppliers. Actually, we find no evidence of that. They substituted to a different supplier. And what did that supplier tend to look like? That supplier tended to be a developing country with revealed comparative advantage. We also check, well, maybe they reshored, but there's no evidence of that. In those in those products where importers were very reliant on Japan, they actually increased overall imports in those product lines faster than other product lines. So they didn't seem to be saying, oh, I better get it from home. They also didn't seem to be nearshoring. There's no effective distance or being in the same region. So it was really a switch to a low-cost supplier, maybe one you feel is more reliant. And that's the silver lining for developing countries, that there's an opportunity now to get into supply chains, but reforms and having revealed comparative advantage will be really important. And we do hear this from many of our client countries at the World Bank. Recently, I was on a call where the head of the investment promotion agency in a developing country said they've actually had more inquiries than usual. There are lots of companies rethinking their supply chains. So this is a time for reforms for developing country and thinking about how to benefit from supply chains. In earlier work, we show there's huge effects of joining because of hyper-specialization. You get the normal effects of trade, but kind of on steroids, as well as these firm-to-firm relationships, which mean that more technology and know-how is transferred. So these things really help to boost growth. So there is this silver lining. In the short run, things are bad, but over the longer run, maybe we'll see some rise in supply chains. Thank you.
Thank you,
Over.
Caroline. Thank you. So let me go to Andres. So this is the second large global crisis in less than 15 years. And we thought that the previous one was bad, but this one was worse. So I looked at IMF data in 2008. There were about 75 countries with positive per capita GDP growth. I looked at the latest IMF forecast. There are like 8 countries forecasted to have positive per capita GDP growth in 2020. Anyway, during the last crisis, you were in government, Andres. So what type of challenges does a finance minister have to face when hit by such a crisis? And you were not lucky, you were good because you had saved some money during the good times, so you had money to spend when the crisis hit. So the first question is like, what does a minister of finance thinks when he's or she's hit by such a crisis? And the second question is, we have a chapter in the ebook about Latin America. You didn't author that chapter. It's by Rodrigo Valdez and Eduardo Levigejati, but I'm sure you talk with policymakers in Latin America and you have many friends there. So if you can tell us something about Latin America.
Thank you, Ugo, and thanks for editing the ebook. Thank you for inviting me to join this panel. People often ask me what I remember of being the finance minister during the crisis, and my honest answer is that I don't remember a lot, because when you sleep 2 hours a night for 2 years, everything becomes very confusing and your memories are even more jumbled than usual. I remember it as an extraordinarily challenging time. What does one think about? One thinks about everything, because 10 years ago, not only were financial markets crashing, everything else was. And of course, if you're a finance minister, you're a technical economist, but you're also a politician and you're worrying about the political system crashing on you. More generally and more academically speaking, I think it helps to distinguish between the initial shock and the multiplier effects of the shock. A good finance minister understands that the shock happened and not much you can do about it. But then it can become much larger because of Keynesian or non-Keynesian multipliers of all sorts, or it can remain contained because there is a suitable macro policy response. Back then, we thought hard about what the macro policy response was. That framework helps us understand why this crisis is different from that crisis. And the main difference is not so much in size, as you pointed out. They're both huge, although this one is bigger than that one. But the nature of the shock is very, very different. I've spent the last 25 years studying financial and economic crises in developing countries, and I've seen crises associated with finance or the banking system or the exchange rate or inflation. We never before had a crisis triggered by government telling workers not to work and by government telling firms not to produce. So in the jargon of economics, this is a gigantic supply shock. And the policy challenge is to prevent that supply shock from in turn becoming a demand shock, which can happen, of course, because if supply is less, then income is less. And if income collapses, then people have no money with which to buy things. So you get a snowball going. The paper we did for the book, I will not describe it in detail, is really a paper that tries to understand what are the mechanisms through which a supply shock of this nature becomes embedded into the system and gets all the, the nasty multipliers going. And in fact, the story is quite related to what Swati was talking about 5 minutes ago. One way to think about such a shock is simply, you run a firm, you expect that in 6 months you'll be able to open up and go back to business, but over the short run you have no income because if you're running a pizzeria, the pizzeria is closed. Now, the real value of that pizzeria is probably not in the flour that is in the basement. The real value of the pizzeria is that you assemble the chef and all the talented people who work there. And if you fire them and they go off and you never see them again, when the economy picks up speed a year from now, the pizzeria will not be as productive, or the pizza will not be as good as it used to be. So the challenge is to remain operative in the sense that you do not let go your team. And of course, ideally, you also remain current on your payments, either with suppliers or with creditors. And for that, you need credit. And the real challenge in many emerging market countries all over the place, but particularly in EMs, has been to make sure that credit gets to those firms. And in the paper, we tell a story in which having the central bank, for instance, open up a credit line is a necessary condition, but not a sufficient condition for this credit to reach all those companies, because banks or other financial intermediaries are in the middle, and the banks will lend if and only if they think the company is viable. But it doesn't take much to imagine situations in which there's more than one equilibrium here. If banks are optimistic, then the firms look pretty good. You lend to the firms, and because you lend to the firms, they don't have to fire people. They remain productive, and after 3 or 6 months, they go back to operating, they make money, they repay their loans. That's one equilibrium. But if everybody's pessimistic, there's no credit, you fire workers. Because you fire workers, the company loses productivity, and it becomes a self-fulfilling prophecy of the bad kind. So there's a lot of room for the kinds of policies that we've been talking about here. Policies which are not conventional fiscal policies. The problem initially is one of supply, not one of demand, and which are not conventional monetary policy either, because not only do you have to make sure that the interest rate is low and that liquidity is plentiful, you have to also intervene in markets to make sure that the money flows. And you can imagine doing that via a furlough scheme, as in the UK. You can imagine that happening through loan guarantees. As Swati was saying, maybe the government will step in and pay part of the wages. Or you could do what Germany has done with Lufthansa. The government steps in and says, I will have a seat on the board in exchange for the money that we provided, and we will make sure that those workers are not fired. Now, doing all of that takes something that you mentioned in your question, Ugo. It's called fiscal space, because all of that costs money. And the question is, and I will turn to Latin America now, in terms of the ability to carry out such programs, Latin America is a very heterogeneous region. There's a handful of countries, certainly including Peru and Chile, perhaps Paraguay, perhaps Mexico, although Mexico is not keen to use this fiscal space, where public debt is reasonably low, where market access, until today at least, is unimpeded. So governments can borrow and they can launch all kinds of fiscal stimuli of the kind that we've been talking about. But in most other countries, either public debt is too high, Brazil, the government's on the verge of default and shut out of markets like Argentina, or somewhere in between, like Colombia. And that makes life hard in Latin America. The other thing that makes life hard in Latin America is the fact that this is not one shock, but five, because in addition to the initial supply shock, you have a collapse in world trade, a collapse in commodity prices, a collapse in all kinds of other sources of dollar income, like remittances. And last but not least, for at least a month and a half in March and April, you had a huge capital outflow. Which leads me to the last point I want to make, and Caroline may have a view on this. I feel very strongly that the international financial institutions are coming up short when it comes to making the necessary financing available to EMs and developing countries. A back of the envelope number was provided by the managing director of the IMF, who said that in the fund's estimate, developing countries and emerging markets need something like 2.5 trillion of support. And that is supposing, of course, they will do packages which are much smaller than rich countries are doing. You know, we see in Europe or the US, countries spending 10, 15% of GDP. In Latin America and other EMs, the numbers are more like 3% of GDP. But even under conservative assumptions, developing countries and emerging markets would need 2.5 trillion. In the best of all possible worlds, the fund can lend 1 trillion. And there's skeptics who say that, in fact, that trillion is more like 0.7 trillion. The World Bank can step in, but the World Bank has limited firepower. The regional development banks have limited firepower. So it is quite possible that many developing countries and emerging markets, which would have benefited from these kinds of policies, won't do them simply because the money is not around. You know, in Europe, Mario Draghi from the ECB said, "We will do whatever it takes." I heard a Latin American finance minister say the other day, in Europe, they do whatever it takes. In Latin America, we do whatever we can afford. And that typically is not good enough.
Thanks, Andres. With the exception of Mexico, that, as you said, we're in this strange situation with a president, leftist, populist president, doesn't want to spend money, right?
The paradoxes of populism. In Brazil, there's a right-wing populist who thinks that the virus is an invention of the press. And in Mexico, you have a left-wing populist who refuses to do a fiscal expansion. We live in a very strange world indeed.
Yeah. Okay, so I have a bunch of questions which I'm trying to put together. Have one for all three panelists. So I'll ask this question, and so then I'll try to read the other one so I get with other questions. So the question for all three panelists is from Nicolas Mestre, who is a former colleague of mine from UNCTAD. And he basically said that there have been many discussions on how to reform the multilateral trading systems. And so what kind of reform you think are needed to support developing economies? I don't know who wants to take it first, if Andres, Swati, or Caroline wants to start. And this is addressed to all three of you.
You guys are trade experts, I'm not.
You did some trade in your life, Andres.
That was a long time ago.
We go to Swati?
Okay. I was suggesting Caroline, but I'll go first.
We'll do both.
So I think one obvious issue here is, of course, how to deal with subsidies. And that's something which we still haven't thought about. And that's true even sort of, that's not a new problem. That's a problem that, of course, possibly even contributed to the trade war that we just saw. So I think that's a serious issue. And I think for developing countries in particular, that's going to be really important because they don't possibly have the deep pockets, just the way Andres mentioned right now. It's a matter of what can they afford to give to their firms at this point or their workers. And that's not very deep compared to what developed countries can do. So I think there's a serious danger here about developing countries possibly really losing out or seeing very perverse reallocation of resources across the world. So I think that at the moment is really fundamental. And the second thing that I think there is a really serious window of opportunity, and which I don't sort of understand why this hasn't ever happened before, or rather, I don't want to talk about the political economy situation there, which is that governments should at this point be talking about tax cooperation, at least when it comes to things like tax havens, because fiscal room is going to be so constrained everywhere that now thinking about that and getting some kind of reform there, I think would be really sort of feasible at this point, that there's more appetite to do so than there ever was. And I hope that something will come out of that as well.
Karen, do you want to add something?
Yeah, actually, Swati said very much what I was going to say, which is around, I think, subsidies and state-owned enterprises. And I think there's a very big danger now because in light of COVID, more money is going to subsidies and money is being funneled to state-owned enterprises as well to boost them. And if a lot of the firms don't survive, as Andrea said, the mid-sized firms, these guys will actually have a larger share in the economy. So I think that's an area to watch and does need to be dealt with. I would agree on taxes as well, both for domestic resource mobilization, as well as clearly there's a problem where capitals become so mobile, especially with the rise in the technology companies being such a large share of what we do, and it's even easier for them. And maybe to add to that, data is another area where I think there's starting to be a lot of conflict on how to deal with the movement of data, and e-commerce and the new areas of trade need to be addressed. And then finally, there's been this special and differential treatment where developing countries in the global trade system have been allowed to participate without having to take on the reforms that other countries do. And it was to give policy space, but it hasn't done anybody any favors, because part of the advantage of being in the system is to have the external pressures that encourage countries to make reforms. And so those have been absent to fight their own internal lobbying and so forth. As it would promote their growth to lower trade barriers as well. And it would allow, especially the large trading countries, to act as equal partners and help to move the trade system forward. And finally, there's just really a lack of leadership in the system right now. And I think that's a problem with all of the international institutions, and probably applies, as Andrea said, about the lack of financing right now. We have 160 billion that we're planning to do over the next 15 months at the World Bank. And that's a drop in the bucket compared to the programs we're seeing from advanced countries. But unless the donor countries are willing to give us more funds, there's just, there's no more space that we have. Over.
Thank you. So we have two questions for
Ugo,
yeah, go ahead.
At the risk of saying something which will not sound like an expert in trade, let me add one thought. Which will bounce off from where Caroline just left a minute ago. The question asked, what do you think the world trading system ought to be doing? As I listened to the question, my reaction was, what world trading system? The only reason why the WTO has been in the news is that the head of it quit. He had been missing in action for the previous 2 years. Once upon a time in our lifetimes, there was activity in Geneva, right? I lost track of when the last WTO round was concluded, but it must have been, 2 decades ago? As a result, the world trading system is something that we all wish existed, but if you look for it, it's going to be hard to find. And this is not so much a failure of people in Geneva, to be fair. The failure is exactly what Caroline just said. The failure is a failure of the capitals. There are many things that could be done to allow the World Bank to lend more. One could provide the World Bank with more capital. One could change the rules so that the World Bank could leverage itself more and lend more on the basis of the same capital. In the case of the IMF, without breaking into a sweat, you could do a new issue of SDRs. You could imagine special purpose vehicles jointly owned by, say, the World Bank and the IMF, such that institutions like the ECB and the Fed could lend to them, and they in turn could lend to developing countries. It does not take a rocket scientist to imagine the kinds of things that the international community could be doing, both on the trade side and the finance side. But that requires leadership in countries which today are completely lacking that leadership, beginning with the United States.
Yeah. The situation at WTO is even worse than that. Not only there is no round, but the arbitration panel that used to work pretty well, they don't have judges.
There are no judges because the US refused to appoint judges, absolutely.
So it's
to injury.
Yeah, so it's bad. So I have two questions for you, Andres. One from my friend Sweta Saxena, who I know she's in Bangkok, so she's up very late to listen to us. And she's asking about what it can be done about creating fiscal space, and she's mentioning, the debt standstill to which, with some co-author, I contributed to the discussion. And then there is another question, again, on fiscal space, but what's your view about, creative measures like MMT or maybe other stuff to create fiscal space?
Okay, or non-fiscal space. Well, those are two fascinating issues, and I could rant and rave about them both for a long time, so I will endeavor to be brief. I am not a big fan of debt standstills, and Ugo and I have had this discussion recently. Yeah. I suppose this is one of those cases in which, where you stand depends on where you sit. And given that my passport is still, and always will be, the passport of an upper middle income country with low debt, I don't think that that debt standstills help a lot. For a couple of reasons. First of all, because unless you have a lot of debt, having interest foregone without any certainty about what happens to principal ain't going to help you a lot. And Ugo and I have had a dialogue quite a while as to what it would take to really be able to include principal, not just interest, in some of these debt standstills. It's not clear that you can, for a bunch of legal and complicated reasons that Ugo would probably explain much better than I could. Secondly, because there could be negative externalities. The rating agencies are not particularly good at discriminating across countries that are in the same region or speak the same language. And last but not least, because what we really need is new money. Let me put on my hat as a macroeconomist for 30 seconds. If a firm with no income keeps spending, the firm is running a deficit. If a government with lost income keeps spending, then the government's running a deficit. So unless households are huge net savers, which I'm sure, they're probably saving more than they would have otherwise before the crisis, but typically households are not huge net savers. Simple current account arithmetic is going to tell you that, a country that is doing things well should be running a current account deficit. So what you need is financing for the current account deficit, and that's new money. It's not simply to get some help with paying interest for the old money, which takes us right back to the issue of new money, IMF, World Bank, etc., which we've probably talked about too much already. On creative stuff, well, monetary anything is not fiscal, strictly speaking. So I would not put MMT on the same category as fiscal space related issues. But let me say the following thing. This is an area which is fraught with prejudice and confusion. And, it is true that in some states of the world, issuing money is like issuing debt. And if you're a country with a big, powerful tax raising capacity and a not too checkered history, you can issue a lot of debt or you can issue a lot of money. And that state of the world is the state of the world in which we are now, namely interest rates are zero. So the UK or the US or Japan or Germany can issue a bond carrying an interest rate of zero, or can issue a unit of currency carrying an interest rate of zero. From the point of view of a saver or an investor, they kind of look alike. So yes, and in some very special circumstances, you can issue a lot of money, and it doesn't mean that it's the end of the world. It will not cause inflation. It will not cause a massive currency depreciation, etc. People are willing to sit on it because there's no other place to go. There's no other place for wealth to park itself. The fascinating question, which is a harder question, is to what extent emerging markets can do that. Because the rich countries are doing all kinds of non-conventional monetary policies. Some emerging markets are timidly beginning to do it. Colombia is doing it, South Africa is doing it, Indonesia, Turkey, Chile, Peru are doing it, but all very tentatively because we don't quite know where the limits are. First of all, interest rates in most of the countries are not zero, so it is not true that money and bonds are perfect substitutes. And secondly, history matters here, right? People's expectations are based to some extent on past events, and when you had a hyperinflation in the last 20 years of your country's history, naturally investors are going to be a bit more reluctant. But frankly speaking, this is an area where I think theory doesn't help us a lot. We don't have good theories of what determines money demand in emerging markets in circumstances like the ones that we are living through today. I get the sense that there's probably a little bit more room to do that sort of thing in EMs than you might have thought, but not in every emerging market country. Can Colombia do it? Yes. Can Argentina do it? Probably not. But we really have to dig a lot deeper to have a good sense of what is feasible and what is not.
Thanks, Andres. So I have a question here for Swati. Let me read it. We know that rigid labor laws, so this is from Raul Merotra. We know that rigid labor laws contribute to informality. So how do you, what do you think about the need for labor reforms, including public support for employees' wage and skill training versus the expansion of job guarantee programs in India? I guess he didn't say India, but I assume he's talking about India.
So I'll interpret it in the context of India for the reason that I really don't know so much about labor laws elsewhere. But broadly speaking, in India, everyone does talk about the rigid labor laws, but we should keep in mind that those rigid labor laws really only apply to 10% of the workforce. The rest of them are actually hired often on contract or informally and do not get the same coverage that extends to these other very privileged set of workers. And I agree that that set of workers is probably very privileged by relative standards. Broadly, though, we have very limited evidence in India that, in fact, the labor laws are very binding. Most of the studies that are cited have seen revisions later from other authors saying how they may not be capturing what we think they're capturing, that rigid labor laws have constrained employment in India. There's not very compelling evidence for that. The second reason I think this is important is because what we're not realizing is that we are in a situation where jobs are just rationed. So either those people aren't going to end up getting gainful employment, or they're going to be on some kind of public employment program, whether you call it wage furloughing, whether you call it a job guarantee, but something that the government is basically putting in the money for. And I think the gain from that at this point, the fact that it would prevent de-skilling, the fact that it would prevent these people from having other things which really matter when unemployment strikes, crime, psychological well-being, all of that stuff is really, really under threat for a population that's extremely young. And youth unemployment is particularly damaging, and that's the reason why I think at this point is not the moment to think about whether we should be thinking of future hire and fire policies that might be better. Most of that is being done very, very sort of abruptly in India, that we're just going to throw out everything except maybe the Slavery Act. And then we're hoping that somehow businesses are going to ramp up employment. I mean, we don't have very compelling evidence to do something as drastic as that, saying that rigid labor laws have actually constrained employment in India. And more importantly, the losses that are potentially going to come out of that could be really, really sort of big. So I think this is not the time to make really risky decisions like these.
There is maybe, Swati, an add up to this. So it says, more than labor laws in India, the problem is poor governance, delays, corruption, and overpriced inputs by government, blah, 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 high taxes and whatever.
That's the definition, I thought, of a developing country.
Well, I'm Italian, and I don't know where you put Italy, but it's also
developing.
It's also there. So there is a question, maybe I'll ask Caroline, putting her hat as former chief economist of the MENA region of the World Bank. So there is a question from Malek El-Khoury, who's basically saying if you could talk a little bit about the Arab world, I guess the Middle East, and maybe differentiating between Gulf countries and I assume countries in, on the other side of the Middle East, maybe, Lebanon, Jordan, Egypt.
I'm not sure I'm really best placed to handle that right now because I've been so focused on trade. I mean, what immediately comes to my mind is within that region is resource importers versus net importers versus net exporters. That the other major hit we've seen during this period is the really sharp decline in oil prices. And so the Gulf countries, which typically have more money to handle this type of crisis, are also in a crisis of their own around lost revenues. And that really, you know, the break-even point of oil for their deficits is you know, over $100 US dollars for several of them, at least from what I recall. So so that puts a lot of pressure, and then it spills over to the rest of the region through remittances. So that's the other really big decline we've seen. So is in addition, and probably even more important for many countries than the trade effects, are the effects of losing remittances. So this is really problematic for that region, where the losses to the net exporters ends up filtering over into the net importers that really depend on that wealth as well for remittances.
Okay. Yeah, so there is this big issue. So
you can probably answer that question better. You should take the opportunity.
Not because of research, but just because I have a Lebanese wife.
Yeah.
So I observe, I mean, Lebanon is in big trouble, but you see exactly this, right? That on the one hand, you benefit a little bit from the fact that the price of oil is lower, but then there is a massive shock because a collapse in remittances. Let me see if I can dig something that, so there are a lot of questions, not a lot, there are a few questions about Sub-Saharan Africa. I don't know if any of you knows about Sub-Saharan Africa, if I can call on Caroline again. Mm-hmm. There is a little bit of a question on what's the impact on trade for Sub-Saharan Africa. I'm sure you know about this. And then there is also one addressed to both Caroline and Andres about financial digital services in Sub-Saharan Africa.
Yeah, on both of those, maybe to start with, so the trade effects we've seen, and this is preliminary data, and sometimes it's from the mirror data, so looking at imports in the US, Europe, China, Japan, countries that report quickly data. We see really large declines in exports from Africa. I think it's around 50% in April. And in part, it's a price effect because they are major resource exporters. Then there's also been some problems around trade facilitation and things like that. There was a really big concern around food security early on. So I you know, the situation is bad. The food security one, I think, has stabilized. When we were talking about the trade system before, the other thing we would have liked to have seen in this crisis is really a response saying, let's not do export bans. And we saw them early on medical supplies. Africa imports just about everything, so they were really dependent there. And then we started to see them worryingly on some food coming out of Russia, Vietnam, other places. They've since, that has not spread as it became clear supplies were ample, that there wasn't going to be a rush. So that side has turned out to be quite good. But the problem in Africa is that there's so many people, and Swati can probably talk about this as well, there's so many people in the informal sector living hand to mouth that you can't take time off work. And so there's really a danger of a lot more people being pushed into poverty if this doesn't, if the situation doesn't improve soon. One thing we're doing is firm surveys. So we're doing these rapid response pulse surveys where we see what's happening. And what we see in the poor countries is that firms didn't actually close, they just reduced business. So, and workers reduced hours. And then getting into the second question, the other thing we see in Africa is an increasing use of digital. And we think we only have 3 countries back. We'll have about 30 by the end of July. We think we're going to see that everywhere, and digital can really help. And, you know, as talking about silver linings, there can be another effect here where, you know, now we've learned to do these webinars. We've learned to pay Africa, you know, using more mobile payments and things like that. That will have a permanent effect, because it's unlikely people will go back to not using digital payments after using them. So there can be a permanent productivity effect of some of this adoption of new technologies. And countries that have more fintech, it's been much easier to reach firms and much easier to do payments and things like that. China, of course, has led that, but we do see with M-Pesa and things like that, Kenya and other countries doing well additionally.
Thanks, Karen. By the way, one thing that Karen mentioned is this ability to work from home or to work. So we have a chapter in the ebook exactly about this and how this is different across countries. There was one question for me, that how can people get the ebook? So I cannot give you the link because I don't remember. But if you Google CEPR Vox EU COVID in Developing Economies, you're going to get a link to the ebook, and you can download it from there. Let me pick a question which I guess it's close to what, if I understand the question correctly, what's close to what Swati talked about, and maybe discussing a little bit. So the question is like, what's the problem with universal basic income? So what's the link about the job guarantee scheme and UBI?
Actually, that follows on really well from what Caroline just said. I mean, most of the ideas for universal basic income really, you know, quite often come from developed countries where you've got really well-functioning tax and benefit systems. You have information about about people in the country, and therefore it's very easy to target them. In developing countries, even in a country like India, so Caroline mentioned Kenya, Peru, India stand out as really good examples in these cases, which is that these are countries where there is a lot of internet penetration and digital penetration, and you would hope that that would take care of most of the problem. So cash transfers did happen in India, and many of them through direct bank transfers, and some of them did go through, but massively we know that, for instance, let me tell you, in our survey, out of the 5,000 individuals that we surveyed, urban individuals, at the lower end of the income distribution, so those who earn less than, in our case, $2 a day, basically barely 20% of them actually got any of the stuff that they were supposed to get from the government. Now, in principle, they should have been credited. That didn't happen for various reasons. Many similar reports are coming out, not just from our survey, but from various other sources in India, that the kinds of transfers that you thought technology could have taken care of so easily would have happened. And 11 years down the line, we're still faced with that problem that COVID has happened and we don't know how to digitally transfer money to people. And I think a lot of it, of course, is for the same reasons that I mentioned before. Where's the information? Where's the infrastructure? If 7% of people pay taxes in the country, of course, reaching them digitally is not going to be easy. Where's the banking infrastructure going to come from? Isn't going to change overnight. So, I mean, these are things that, yes, one needs to keep working on over the long horizon. But at least as things stand at the moment, a lot of people are falling through the social safety nets that we thought technology would have corrected. And I think one of the main reasons is the same problems that are there when you write paper muster rolls of people, and when you try to get them to go to a government office, the same problems persist. Same sort of systematic exclusions and omissions of people happen even digitally. So in that sense, the digital aspect of it is really promising, but at the moment on the ground, it doesn't exist. And that's the sense in which UBI can be great if you were able to easily target people, and then when you wanted to increase the targeting, you could do it immediately. It's not quite there, that infrastructure yet in many developing countries. And more importantly, even if that infrastructure is there, that's very good for handling some kind of, say, short-term income risk. But if you're talking about long-term unemployment and the other effects that brings with it, necessarily UBI isn't going to be the only solution that you're going to need. You're probably going to need much more than that. And I think that's the sense in which a job guarantee those were the reasons when the Indian Rural Employment Guarantee Scheme was put into place, that, you know, that was the public debate. And I think many of those ideas still, and many of those constraints are still there, that we can't just simply throw away the idea and say that we can do cash transfers and UBIs really well and that should do it. There's also, of course, the finance angle, which is when you have real serious fiscal constraints, which many countries now will, then where are you going to produce the money to give a universal basic income? You're probably going to do some kind of targeting. And the moment you start doing targeting, now we're again getting back into information and infrastructure issues. And I think that's been the really big challenge in countries like India.
Okay, good. So there was a question. Now I lost. Oh, a question from Daniele Ottolenghi. So what Daniele is asking, I guess it relates to something that Andres said, that, you know, there's this estimate that we need 3.5 trillion. And Daniele Ottolenghi is saying, you know, you have all the advanced economies which are busy using all the money they can use to stimulate their own economy. Where is this 3.5 trillion coming from?
Well, if there's one thing that the world has an ample supply today is liquidity. We know that from one very basic fact, the interest rate is zero. So when something has a price of zero, it's because supply is running ahead of demand. So all I'm suggesting is that some of that very abundant supply of liquidity in dollars or euros or pounds, we help it go south. Given how much money is being printed in the rich countries, I don't think that would have a dramatic effect on interest rates worldwide. You know, we're not talking about amounts of money that are large enough to really have an impact on equilibrium world real interest rates. So the question is, who is the intermediary? I think it is not reasonable to go to the ECB and say, hey, would you like to take some Thai risk or Indonesian risk or Colombian risk or Uruguayan risk? But that's precisely why we have institutions like the Asian Development Bank or the Inter-American Development Bank or the African Development Bank, or maybe the World Bank, or maybe the IMF, or maybe all of them put together. So the money is there. The uses of the money are pretty obvious and have, you know, to use economics jargon, high social rates of return, you know, doing the kinds of things that Caroline and Swati have been describing. So what we need is some financial engineering to get that money where it ought to go. It is not an impossible problem. Money is plentiful. What we need is some people willing to lead, politically speaking, and that's exactly what we're not seeing today. One last thought. I am not making some sort of plight for altruism. I am not saying that citizens in rich countries in their immense wisdom and generosity should be subsidizing citizens in poor countries. I'm making a much more practical point. Depending on how you measure it, emerging markets, including China, are anywhere between 45 and 60% of world GDP. So if emerging markets go into a tailspin, this will be terrible for emerging market citizens. It will also be very bad for rich country citizens, because the world economy is not going to grow a lot if 60% of that world economy is doing badly. You mentioned, Ugo, at the outset, the comparison between this crisis and last crisis. In both episodes, the biggest short-term collapse in output came from the rich countries. And what kept the world from going into a generalized depression in 2009 was the fact that the Polands and the Turkeys and the Indias and the Chinas kept growing. And other countries in South America contracted, but much less than Europe. You know, countries, you know, Chile contracted 1%, 1.5%. This time around, the rich countries are going down, you know, into double-digit negative territory, and the emerging markets are in negative terrain themselves. Maybe not double-digit, not all of them. So you add it all up, and the world is doing very badly. So the call here is not for altruism. This is not, you know, give us your money and we'll, you know, walk away with it. It is in everybody's interest to have a more dynamic world economy. it is in everybody's interest to allocate liquidity to places where it has a big return. We're just being blind and intellectually and politically lazy if we can't see that first and then do something about it.
Yeah, our friend Ricardo Hausmann had an article on the FT a few days ago with also very strong language along these lines. And it's, I mean, I remember a graph by Gian Maria Milesi Ferretti at the fund at the time of the 2008 crisis, which showed what exactly you said. Basically, the main driver of world economic growth was China at that point. It was really the thing. And there is another issue which is picked up by a question here. I forgot the name of the person who asked, but there is not only sort of an economic externality, it's the fact if contagion go up in developing countries, they're going to spill over again to the advanced economy. So there is also health externality linked to that.
Of course, this began in China, right? It did not begin in your native Italy, although it got out of hand in your native Italy. No, the phrase that has become fashionable nowadays is "no one is truly safe until we're all safe." That is a punchy little sentence, but it also happens to be true. Do the U.S. and the rich countries in Western Europe want to spend the next 5 years worrying about quarantine, who gets off the plane, and how likely it is that we will be victims of contagion again? I think we don't, right? Because ultimately, it is not only distressing; it's bad for our own economies. You know what will happen to the tourism industry in London, where I happen to be right now, if no Russians, no Chinese, no Japanese, and no Brazilians can ever come here? It is not going to be doing very well, right? So yes, we need a worldwide response, which is exactly what we don't have today.
I'm trying to. Sorry, I just tried to do too many things at the same time, reading questions and. I have another question for Andres, but I was looking for one, so I'll ask this one for Andres, and then I'll look for question for Caroline and Swati. So there is a question from Emmanuel Laredo from Bolivia. And so what Emmanuel is asking says some countries in South America are trying to propel the economy while COVID has not been controlled. Do you think it's the right way? Or should we first control and then focus on economic? I guess it's a more general question. This is in the focus on Latin America, but that's a question we'll all be struggling with. And just to say something you said before, as economists, we always think about creating incentive for people to work. And now we have been thinking about incentive for people not to work, which
absolutely. I think Latin America is an extreme case of a more general world phenomenon, which is we have created a false opposition. In Latin America nowadays, the political debate is described as being one between, the nice people who care about health and the not so nice people who want to open up the economy. There may be a grain of truth in that, but I think that's a false trade-off for a couple of reasons. The first one is that we have learned that countries that took decisive action against the pandemic not only made gains against the pandemic, they're also doing pretty well economically. Or if you look at Europe, the countries that were fairly lax in dealing with the pandemic, the UK, where I happen to be, or Sweden, are not performing very well on economic grounds. So that's one reason why the trade-off is, I think, inaccurately described, if a trade-off exists at all. Secondly, what I just said should not be interpreted as saying that we worry about the health and we neglect the economy, because even if we think that human life is the most important thing by far, and even if we care about human life and life alone, in low-income countries, if the economy crashes on a sustained basis, we will not be doing anything that's particularly good for human life, because people quite literally will not have enough to eat. I wrote a piece in a newspaper the other day, and I asked him to put a picture from a demonstration in Medellin, Colombia, in which a gentleman with a sign says, I'd rather, I'm going out to work, I'd rather die from the virus than die of hunger. So this is not a fight between the good people who care about health and the bad people who care about the economy. We should all reasonably care about both. You know, the economy is important for health. Health is important for the economy. It's pretty clear that we need harsh measures, at least early on, to contain the virus. But it's also pretty clear that we have to do it through intelligent incentives, like you were saying. The main reason, or one main reason for being generous when it comes to, say, cash transfers, is precisely that such cash transfers allow people to stay home. And that's the way I think we have to go.
So there is one question from Anima Sharma. I'm not sure if it's best addressed to Swati or to Caroline, or maybe both of them. And so the premise of this question, which I don't know, it might be true, but so the amount which was to be spent on development has been diverted to health, and this is hurting small businesses and entrepreneurs. So what strategy could be adopted to help this group of people to survive the crisis?
I can do a really short response to that. I think one thing that governments are doing here already, and which to some degree is happening in India, for instance, is loan guarantees for small and medium enterprises, and trying to give them some level of loan holiday, which might help them for some time. But I think these are really difficult times in general for business, and I think we are going to see a lot of closures.
So in fact, before I give the microphone to Caroline, we have a chapter in the ebook. So I'm trying to pitch the ebook. It's like, you know, sometimes economists, we think about this process of creative destruction. So my big crises are this big, you know, purifying things because we weed out all the bad guys and only the good people survive. And there's all sorts of this almost Darwinian mechanism of the crisis. And we have a chapter in the book showing that that's often not the case. So this Schumpeterian idea that crisis weed out the bad people doesn't seem to be true. A lot of productive firms actually suffer and disappear during this type of crisis. And so there is actually real entrepreneurial and productive capital that gets destroyed when we have this type of crisis, which is something linked to what Andres was saying before, that is like, you know, if you make pizza, it's not so much the flour that you have in the thing, but your ability to organizing the pizza production process, and that gets destroyed. But Caroline, I don't know if you want to add something to that.
Yeah, sure. So we've been focusing a lot of attention on the response on firms. And I think actually this builds off some of what Andreas was saying and what Swati was saying, that the way we are structuring our response at the bank started with relief, which was mainly a health response, but then switched into the recovery. And the relief was both health and firms. So how do you keep viable firms alive for the future? And then there's also a bit of restructuring that I don't think we want to think about everything being closed. We have to think about ways to operate safely. So transitioning to e-payments, doing as much electronically, putting in the kind of plexiglass barriers we're seeing in supermarkets, asking people to stand 6 feet apart, but not asking them to stay home. And of course, essential supply chains need to continue functioning or people won't eat. And then finally going towards recovery. Then in terms of what you mentioned about creative destruction, absolutely right. It's not creative destruction, it's pure destruction right now, because you know, there's lots of productive firms, new firms that don't have that much cash on hand. So you don't want the liquidity problem to become a solvency problem. So that's where, as Swati said, the firm support loans to firms, doing what you can to lower operating costs, clearing government arrears to give firms money is a great way, because it's at least not distortionary. But it's really important these measures are time-bound, they're transparent, they can easily be captured. Unfortunately, many developing countries don't have capacity to implement them. So we're monitoring the programs countries are doing around the world. We have actually a tracker online you can look at, and it describes the type of programs, and you see them all over. The problem is when we survey the firms, we find in some countries, you know, as little as 1 or 2% of firms are actually taking advantage of these programs, because, I mean, we saw how hard it was in the US on the first round to get the money out. It's that much harder where institutions are weaker, information's, data systems, all that. So, so this is a really difficult question to avoid that economic scarring, but to the extent possible, I mean, I think ultimately a lot more funds will be spent on the economy than will have been spent on health. And I think that's what we're seeing in the World Bank programs as well, that initially a lot of it was about health. Now it's much more about supporting the economy and helping people to survive, and social safety nets, of course, as well.
Okay, I think we addressed basically all the questions. There are several comments about issues related with the poor quality of politicians, which it's not just a problem in developing countries, or maybe it's anyway, let me not comment on that.
And you can relate.
So let me just maybe we conclude here, unless Swati, Andres, Caroline, there is anything you would like to add. I think
just one thought. I've been delighted by the fact that in the middle of this pandemic, we have been talking not just about the macro response, but about issues like informality, labor demand subsidies, universal basic income, and all of the above. And I think there are two debates going on here. One is the technical debate as to, you know, what is the best thing to do in that domain. I myself, I'm fairly skeptical about UBI. I like negative income taxes of one kind or another as a way of stimulating demand, but that's a technical debate. The side that worries me most is that in many countries, politically, this debate has become very toxic, because anything that you modify in the labor code becomes either a subject that the business conservative world, you know, goes to war over, or a subject that the left-leaning union-connected world goes to war over. And so most governments of most political colors simply say, this it's too hard, I'm not going to touch it. On top of it, because some of these measures are fiscally expensive, whenever you talk about it, there's another lobby that says, oh, too expensive, let us not talk about it. So when everybody's saying, let us not talk about it, we don't talk about it. And as a result, we have, you know, the number that Swati gave at the outset is extraordinary. You know, being from Latin America, I always think of informality maybe being a third of the labor force, maybe being 40% of the labor force. Swati, you said 80% of the labor force in India. You know, that is just an extraordinarily worrisome state of affairs, right? And the consequences of informality, we always knew it was bad, but the crisis, you know, reminded us of how bad it is in so many ways. So my only thought in the end is political. Will the political equilibrium change in some way because of the crisis? Will we have fewer veto players vetoing any progress in this area? Can we be hopeful that politicians will pick it up and run with it? I'm not sure, but at least we can hope.
Thanks, Andres.
Maybe if I could come in on that point, just to, as a closing thought, I think if you think of pandemics, finance, trade, one thing all of these, and by finance, I mean financing for the developing countries, as Andreas was talking about before, and the need for it not as altruism, but it's in our own self-interest. One thing all of these have in common is externalities. That what one country does affects the policies there, have big spillover effects to the rest of the world. And that means we need cooperation. And so, which has been so absent. And to the extent we could, that ultimately we can come out of this with some realization of that and a renewed sense of cooperation for global economy, global well-being, more equity around the world within and across countries, that would be fantastic. Hard to see right now, but sudden changes do happen.
Good. Swati, anything to add?
On that optimistic note, I think I should just stop here. I wish Caroline and Andres were running governments.
Well, we hope in the future.
I was once in government. All I got was all this white hair.
Okay, so thanks to everybody. It was great to have you. Great, thanks for contributing to the ebook. By the way, somebody posted on the chat the link to the ebook, but again, 2 minutes on Google. You'll find it. So again, thanks to CEPR and the International Development Policy for putting the ebook together, and to all the people who contributed to it. And thanks to Swati, Andres, and Caroline.